Hey, everybody. Welcome to July the 1st, close to July the 4th, which is why we're wearing this today. I hope you guys are doing well. I hope you have a fun weekend planned and you have some wonderful time to celebrate freedom and independence with your family and loved ones. As you guys are getting on here, just so you know, you will not be seeing Jack Santaniello. He is under the sea and trying to avoid sharks to keep his wife happy. But so he is getting a much needed break. But we do have Adam Boatsman back, fresh and ready to roll, which is really good. It's good to have you back, Adam. I'm glad you had some time. Maybe you can even give us a little update on that. Also, doggone it, I forgot my swag downstairs, but Chuck Cooper with Whitewater Consulting will give you a shout out with some of your cool swag later on at another event. But met with him and he actually provided us some really good questions that he's dealing with as part of his HR consultancy with focusing on the same kind of folks that we work with, privately held businesses. From small to medium size. So anyway, Adam, do you have any preamble or anything that I know you want me to, you've got some things that you want to share with us as well. I'm going to go ahead and give you screen share capabilities right now. And you are now the host. So there you go.
All right. Well, thank you, Gary. Happy to be back. So that's funny, Joe. I can't say anything to Greek. And the real humorous thing that happened is that, I was in a fraternity in college, so I learned the Greek alphabet. And shockingly, they don't just spell English words in the Greek alphabet. So my knowledge of the Greek alphabet was no help with translating. So there you go. But it was nice. I'd if you get a chance to go there, I'd highly recommend it as a destination. It was a lot like the Caribbean, but with 3,000 years worth of history, a little bit colder water, a little bit longer flight, and way better food. So it was a lot of fun. So happy to be back now, and thanks to Jack and Gary and John and Matt and the guys who filled in while I was gone. So to kick off for today, given that there hasn't been a whole lot of new things that have come up in the last week, Gary and I made the executive decision to focus on a few back to basics things as people are starting to come back and return back to the real world, or some of us have been back, but it's time to really start getting focused back to business as usual. But with respect to, all things stimulus, all things tax, the big news of the last, week or two was the bipartisan infrastructure deal that got announced. So what they agreed to was a package of infrastructure spending items that both parties agreed to being real infrastructure, meaning roads, bridges. There was some renewable energy stuff that sits in there. But, the big question so that's all great. I'm happy for that. I appreciate it. And at the same time, the stuff that's really relevant for us as a business and as business owners is, well, how the heck are we going to pay for this stuff? So what it looks like in this first proposal, assuming that some version of this is what ends up passing, is that the method of payment, it's relatively good news. It's kind of what we expected, which is, one method of payment is enforcement. Another method of payment is just using, so this also would affect this, is just using stimulus money that hasn't been used yet. Another method of payment would be to, I don't know if it was reduce the duration of unemployment benefits, or alternatively just use the unemployment benefits that were earmarked but went unutilized for the states. But basically it's all things kind of stimulus that didn't get used, redeploy it for this purpose. And really the only tax increase that was sitting in there was it would impact, some of us, but not all of us in the traditional way. There's some back and forth on whether or not they would raise the fuel tax, because I think that I don't remember the specifics of this, but they haven't really raised the fuel tax in a long time, which was a primary way of paying for infrastructure. And then the second thing that they probably should address, and look, I don't like it because I have one, but at the same time, I have an electric vehicle, so I don't use gas anymore. Thus, I'm using infrastructure that I'm not currently paying for. So there's got to be something that's done around an electric vehicle and making sure that I'm paying my fair share for the use of the road the same way as Gary's paying his fair share in that gas guzzling Mazda light SUV that he's got. So that's good news on this front. There's also the talk still of the push to push through the other infrastructure, which is the human infrastructure component through whatever, the reconciliation process where they don't have to get any Republican votes, which would include some more traditional tax increases. But, who knows if that second piece is going to happen. It seems like there's a lot of people wanting to have a win on a bipartisan front now at this point, which I'd agree with. It'd be great for the country to really focus on that piece. And instead, the method of paying it, isn't anything that's really going to be painful, except for those that have on-road fuel costs. There's still talk of, using some form of a fuel tax increase to help offset some of the cost. So anyway, that is what we know on the tax front. On the North Carolina PPP front, still nothing new. We're making the call internally that, look, if the legislature hasn't gotten off the dime, kind of by the middle of August, we're going to go ahead and file all the returns we've been sitting on. It's going to be somewhere in that time frame. So if you're not a client, would suggest you do the same. If you are a client and you're wondering, hey, I wonder where we're going to file the tax return, that's kind of the time frame that we're looking at it on the PPP forgiveness front. So that's the big stuff that we know about this week, Gary. I mean, all the other same tax proposals that they had on the table in terms of rate increases, the like-kind exchange going away, estate tax, all that kind of stuff, that is not part of this first package. That would potentially, elements of those items would potentially be parts of package number 2, which would be the reconciliation process, which again, as Tom Hanks was fond of saying in Apollo 13, the clock is ticking. I mean, as we get deeper and deeper in the year, the likelihood that any of that stuff will become retroactive back to, if it even passes, the likelihood of it being retroactive in 2021 gets lower, and it's already low, and it's getting lower and lower by the day. And no, they don't, Joe. They laugh at you at US dollars. You need to have euros. So there you go. Everybody does speak English, but they do not accept the US dollar. You got it. So you just go to the ATM and get some euros and pay the fee.
Yeah. What do they say? This is not Mexico, man.
Yeah. It's about 70 cents on the dollar. That's the bad news. The good news is tips already included. So, we still tipped. We tipped about 10%, but tips included. So there you go.
Well, you could speak Greek a little bit. You could just go up in order and say alpha, beta, gamma, delta, epsilon, right?
No, yeah. And it's funny, Greece is not Italy yet. We found ourselves reverting into an Italian accent. So there you go.
That's awesome. Well, while you guys are, first of all, did you want to do some screen share, Adam?
Yeah. I just wanted to, I think maybe if we just ask, are there any, if anybody has an immediate round of stimulus or recovery related questions, we'll get those out of the way. But then we did want to talk about some back to basics business management stuff that'll take about 20 to 30 minutes, I would think.
Yeah. So as you guys are formulating your questions, it's funny because Joe's already found the chat button, so that's good. You know what that's for? The Q&A is where you hit your questions. And we do have some questions that, again, Chuck Cooper gave us. But another thing that's probably worth mentioning, don't you think, Adam, is ERC and ERTC, the Employee Retention Tax Credits. We keep having more and more clients asking about that. We have been through a number of meetings vetting out a legitimate source that we trust. And so we'll have more news to talk about that and being able to help people. But the protocol that we've been recommending is, unless you are on life support and you need the money now, you got 3 years, and take a deliberate approach to this. And I'll have a meeting this afternoon with a large restaurant group where they've got friends that got money. Hey, they got money already. Well, it was probably from 941, not 941X. And that was probably because it was done in Q1 and they got it submitted before April 15. And so they have, but to their knowledge, and this is a group that is the leading group in the country, no 941X money, meaning that from the ERTC, I think it was Q2, right, Adam?
Yeah, Q2 2020. Yep.
Yeah. Nobody has received any funds there. And that we're hearing delays from the time that you submit and yes, you've qualified and you're verified, the submission has happened. Anywhere from 3 to 7 months is what we're hearing.
Yeah, so. And to dive into that in a little bit more detail, Joe's been such a good person on the chat, so I'm going to ask for forgiveness later in terms of using Joe as an example of why we're saying, hey, we're aggressive, but let's proceed slowly to make sure that we have it right. So, the revenue reduction requirements of the employee retention tax credit, that's no brainer. Down 50%, 2020 relative to 2019 quarters, down 20%, quarter 2021 relative to 2019 quarters. You hit the revenue reduction requirement, it's a no brainer. It's the exceptions whereby you actually were not down greater than 50%, but due to government ordered shutdown, which, there's definitions of what actually constitutes a government order shutdown versus a preference item. Do you also potentially qualify? So using Joe's business as an example, some of you guys know what Joe does. Joe services financial institutions, primarily small to mid-sized banks in terms of, ATMs, cash counting machines, stuff like that. So, it's kind of, most of the stuff is like, hey, I need to go to a branch to do something. They can do some offsite support services, but most of it is like, I literally have to have a butt on the ground to go do something. Well, I don't know about you guys, but, banks effectively closed. Like, they shuttered branches and they shuttered branches, and then the branches that were open were operating on a reduced capacity. So indirectly, Joe's company actually was disrupted due to the shutdown. So I think there's a good case that, Joe potentially qualifies. However, there's lots of conflicting information that currently exists. The IRS hasn't published a lot of guidance. So the challenge that you get in here is that the IRS, they did one nice thing on the front end with the employee retention tax credit, which is extend slightly the statute of limitations of when you could apply. So it's still 3 years to apply for a refund. And they said, look, regardless of the quarter, for the purpose of the first quarter that you're eligible, the starting point is effectively, Q2 2020. So you've got like an extra 6 months on top of the 3 years to apply for the credit for that very first quarter. So there's plenty of time, and this isn't a limited first come, first serve bucket. There's plenty of time. But what they also did with that is they said, little known, oh, by the way, we'd like to extend the statute of limitations of when we can audit. So they increased the audit period. So that's just, that's kind of a bad fact in the sense of, if you rush headlong into the credit and you're not really careful on it, and you're not really careful about the partner that you pick that's advising you on whether or not you qualify for this exception. I mean, a lot of these places are, got stood up simply to capitalize on making money off PPP and the employee retention tax credit. When that goes away, they're not going to be in business anymore to defend you when, 5 years later, the IRS says, hey, by the way, we're ready to start auditing that stuff now. So that's why we're saying proceed with caution, is because we do think, based on the exception clause, based on the revenue reduction requirement, BGW did not have a ton of clients that qualified. But based on the exception clause, we do believe that several, probably greater than 50% of our clients are going to qualify. But we want to take time to make sure that we've got the methodology right, because we know that we're going to be the ones that have to defend the position that we took on the credit. And again, those of you guys that know me know that I'm going to be aggressive, but I want to be aggressive in a way that I know that I can win, not in a way that I'm not confident that I can win. So that's why we're saying, hey, let's proceed with caution. So as Gary pointed out, we're partnering with people currently that have kind of a like-minded view of, hey, let's make sure we get it right, to come up with what our exception criteria is, so that in quarter 4, quarter 1, we can start the process of, okay, let's get the ball moving here in terms of getting these credits processed. So what you'll see from us is, sometime in the next 2-3 weeks, we're going to send out kind of a broadcast email saying, all right, we think you might qualify, click here to make sure that we follow up. But in the meantime, as always, if anybody has any questions about their specific facts and circumstances, hit up FAQ@trustpgw.com. But as I said, it's based on, the exception clause of, look, if you were disrupted because you could not work, like you couldn't telework because your customer was shut down, or significant portions of your operations were shut down because they were considered discretion. Like a good example, medical practice, if you had an emergency function, that was required to stay open, but everything that was discretionary shut down. So, people that service people that did discretionary medicine, by default, they were shut down. So it's a pretty broad list that we would just want to make sure we get right.
So I knew we could count on David to send us some good head scratching questions. So and both of these questions have to do with ERC. So the first question is, if you qualify for ERC under 2020 rules, do you have to requalify in the first quarter of 2021?
Meaning, I don't know if I quite understood the question, but what I would think would end up happening in that scenario is that you qualify under 2020, and then this is if you had the revenue reduction. You qualify under 2020, and then by default, you would roll into, the last quarter, the first quarter that you go greater than 80% revenue restoration is the first quarter that you stop claiming. So it's like you get the benefit of that last quarter. So if last quarter is like 83% relative to the same comparative quarter in 2019, you still get that quarter for the employee retention tax credit. So I wouldn't think that there would be requalification on the revenue reduction. With respect to the exception, there hasn't been a lot of guidance on its interplay with the 2021 rules, but my feeling would be that since it's meant to be localized, that would depend upon the jurisdiction. So if I'm in I can't think of any in the country right now that this would be the case, but if I'm in a localized area that still has some form of government mandated slow down capacity restriction. Well, actually, good one would be movie theaters. I think movie theaters is still at 50% capacity. In theory, they're still going to qualify for this in 2021, based on the fact that they're still subject to a shutdown or a restriction in capacity that's beyond 10%.
All right, cool. One more question on ERC from David. He says, tell me more about, you've got 3 years to apply for ERC. I understood it was 18 months from June 2020 to submit 941X for Q2 2020. 3 years?
Yeah, Everything that I've seen, David, is that it's the same statute of limitation for any refund. It's just that it's associated with the quarterly reporting date rather than an annual reporting date. So like tax return, it's 3 years from the file date or the original due date or extended due date. In the case of 941, it's the same thing. It's just those happen to happen each quarter. The only exception is that this is off the top of my head because it's been about a month since I looked at this. For that first quarter, they're saying that we're going to assume that that's the quarter 2 reporting date, which would be sometime in the June timeframe, would apply to quarter 1 of 2020. So they extended the due date for that first quarter only. But outside of that, unless if you found something in 18 months, Dave, please feel free to send it. I think what other people have learned on this call is that I'm not afraid to say that I was wrong. But I'm pretty sure it's everything that I've seen is that it's the same statute of limitations as everything else with respect to a refund.
Yeah, just one more little comment on this whole ERC. As we've talked to various groups that are doing this, we've seen, and we've had a client that got solicited by a group that then said, oh, and by the way, your CPA firm qualifies, which was a red flag for us, right? So this particular group that we're talking to, they were shaking their head going, no, no, no. And they actually have all of the executive orders to back up everything. If some, and one of the things that I liked that they've said a couple times is one of our advantages is we say no, because they have that same responsibility that we do. They feel that same responsibility. And I think, didn't you say, Adam, that the statute of limitations, like they could come back up to 7 years?
Yeah, I can't remember if it's 5 or 7. Whatever it is, it's longer than normal. They extended the statute of limitations.
So again, just beware. And if somebody out there wants help from us, we will issue a more definitive protocol. Here's how we're going to do it, and here's how we're going to, but I think it'll be good. So anyway, next question, if you're open for another one, we're going to shift gears though. This is from Chris. Any discussion specific to changing the qualified opportunity zone capital gains tax incentives? Have you heard anything?
I have not seen anything for that with respect to the tax proposals that are out there. And that would be, there's part of that would say, hey, that would end up being counterproductive in some respects anyway, to what a Democratic administration would want to do anyway, since it's meant to be targeted towards investment in distressed areas. I would see them not messing with that. I haven't seen anything proposed to say let's do away with that.
In a kind of related scenario, can you talk at all about what possibly is in this legislation on 1031 exchange?
Yeah, basically they're just saying bye-bye. with the exception that there'd be some cap on the amount of gain that you actually could 1031. I think the proposal was $500,000 was exempted. Off the top of my head, but it effectively would go away. Now, what that typically means is that if I'm in the middle of a 1031, it's not like all of a sudden they're going to say, oh, sorry, buddy, you need to write a check right now. It's more like once you divest yourself of that asset that you've been 1031ing into over and over again, then the tax would finally become due, and you'd have a limited amount of gain that you could then roll over in the future.
All right, so we do have another question that's related to PPP, et cetera. So he says, and this is from Joe, do you have any clients, not using names, that have not been awarded 100% loan forgiveness on PPP?
No, we just, we'd heard about some challenges with one large regional bank that was taking a very conservative approach to what people should have applied for in the first place, and saying that you over applied or we overfunded you but that doesn't have a relationship to the forgiveness side of the equation. So that's the only cases that, and even then, we've also heard that with that same bank, they when they were pushed back against, they said, "Oh, sorry." So, to answer that question, no, we haven't heard of anybody specifically that's been left with a loan. I mean, we've had some clients that couldn't spend the money. We've heard stories of others that were going to shut down operations and have wondered what to do with it, but nobody that's specifically still an operating company, still running strong, and somehow the forgiveness application got turned into a partial loan. We have not had that happen.
So just a quick shout out to one of the guys that pushed back on the big regional bank, Robert Mayetta. And next week is his 2-year anniversary for Survival CFO. And so he pushed back and he won for his clients. So I think that's pretty cool. So let's see here. Okay, so, and this is in chat from David, but it's probably worth mentioning. Like Adam, I've got a couple clients who've not gotten full forgiveness based on overfunding the initial loan also. And then he mentions a couple banks here have all forced a clawback of the original amount, a couple of the big banks, including this regional bank. And I'm avoiding their names right now just because I'm not into big public shaming, but so.
Private shaming, yeah, it's public.
If we could do it one-on-one directly with the source, fine, but yeah, public forum is probably not the best. So you want to do your screen share while we're waiting for some additional questions?
Yeah, absolutely. So, when Gary and I were prepping for this week, part of what we're trying to accomplish with this series is to also just talk about what are the questions that we hearing during the week or during the month that are coming up during the course of day-to-day, because chances are if I've heard it more than 2 or 3 times, that it means that it's on a lot of different people's minds. So, for this week, it really, the couple themes that we've been hearing outside of the normal, tax stimulus stuff is really around, well, how much cash should I keep on hand? I had this, kind of one-time shot of working capital injection. How much cash should I leave on hand? Should I have on hand? And this really, this comes into play in terms of, A, how much cash should I have on hand? But B, some of our clients are going through, either a full sale or a partial sale. It's an inside sale if they've been maintaining, pretty significant cash reserves. Well, that was all fine and good, when I owned the company, because whether it's in my bank account or it's in the company's bank account, it's still my cash. Well, now if somebody else owns the company, I don't have that cash. So, it just kind of highlights getting your cash right going forward. Because if you take like what's a typical example of, something that sucks for us to have to deal with? Gary's running his company. I'm a CPA. I've been advising him, for years. Gary's got a, $3 million in revenue company, and he keeps $1 million in his cash account. And every year I say the same thing to Gary. Gary, you got too much cash on your balance sheet. I know, but it just makes me sleep better at night. I know, but it just makes me sleep better at night. So, over time, Gary, builds the company up from 3 million, and, now it's a $10 million company, a couple $1 million in EBITDA. Gary's doing pretty well. And he says, "Hey, Adam, I'm ready to go ahead and sell the company." And he asked me, "Well, how does that work?" And I start to explain, well, you come up with the valuation of the business, and, you'll agree to the value, you agree to the terms, but be real careful, because part of the terms are going to be how much working capital needs to be left in the business. Working capital is cash plus accounts receivable plus inventory less current liabilities. And every buyer does the same freaking thing. They leave it till the last minute after they've worn you out on every other term. Then they get to the working capital adjustment. And Gary says, okay, duly noted. I'll make sure I keep my eyes on that. And then he completely proceeds to ignore my advice. I swear that I'm only bringing this up because it's never happened. It's just theoretical. No, this happens every transaction that we go through. So then at the last minute, Gary comes to me and says, hey, man, this is crazy, but they're trying to calculate a working capital number for me, and they're using the average of the last 12 months. Or they're using, period comparisons. Well, you know that I leave too much cash in the business. I mean, you've been telling me that for years. What do I do? It's like, well, now it's up to me to convince the buyer that the company doesn't need as much cash as Gary's been leaving in. Their answer to that be, why? Is Gary stupid?
Yes.
And my answer is yes. So it's just, we just felt like it's time to get back to some basic business principles, especially as a lot of our clients are contemplating some form of a transaction, even if it's selling 10% of the company, to a key employee. The cash that you've earned up to that point is your cash. You ought to distribute it and run the company like a real big boy company after that. So what we want to highlight with this presentation, with this webinar, is just to focus on, look, if I focused on nothing else, nothing else as a CEO, what are the things that as a minimum I should keep my eye on? So with that, let me go ahead and share my screen. Gary, you should be able to see my presentation now. So confirm to me that
It
you
is
can.
up.
All right, really cool. I'm also going to try my new fancy pen toy here. So hopefully that works as well. All right, so how, this really has two components. How much cash do I need? And then we're also going to talk about profitability for a little bit. So in terms of how much cash you need, the technical accounting term for that is called working capital. So a lot of times, well, what's working capital? Okay, working capital, literally, I get asked this a lot. Working cap, you take for granted that I know, I've been doing this for years, so how could you not know this? Okay, well, you don't have an accounting degree. I got it. Okay, so working capital is literally what is the capital required to operate the business such that it does not experience cash flow needs or cash flow hits. And if you think about Goldilocks and the Three Bears, that working capital is, this is too little, this is too big, this is just right. Like, think about it from that perspective. You either have too little of it, you have too much of it, or you're going for just right. And once you got it just right, you don't want to go back to too little of it or too much of it. You want to keep it just right. So working capital is cash plus accounts receivable plus inventory. And inventory is, either inventory in the classic sense, which is, literally raw materials or work in process or finished goods, sitting on a shelf if I'm a manufacturer. In the case of a professional service firm like us, it's the inventory of unbilled time that we haven't billed clients yet. If you're a construction company, this is really your cost and excess account. But it's basically assets on your balance sheet that either are cash or will be converted to cash, sometime in the next 12 months. And it's the ratio of that as the numerator versus accounts payable plus the current portion of your long-term debt. I mean, you could accrue for some wages and bonuses payable and stuff like that if you wanted to, but generically it's accounts payable plus current portion of long-term debt, which if you only have a line of credit, a good rule of thumb is just use 12 months of interest only payments, or alternatively, treat the line of credit as if it was on a 5-year note and take 1 year of the note payments, just so you get some, technically a line of credit, if it's renewable every year is all current, but it really screws up this calculation. Therefore, if you have the whole balance in it, therefore, pretty much every bank on the planet will agree that it either should be interest on a line of credit, or alternatively treat the line of credit as if it was 5-year debt and just use 1 year of it. So what are you looking for here? You're looking for a ratio of 2.0. That's, doesn't matter the industry. You're looking for a ratio of 2.0. And if you're not at 2.0, a lot of you run out, do the calculation like, crap, I'm not at 2.0. What do I do? Well, it takes time. Like if you're not at 2.0, it takes time to build this up over time, because it means either not distributing cash out to yourself, or otherwise, or otherwise boosting sales. So it's boosting your accounts receivable and conversion into cash. So at a minimum, as a floor value, kind of 1 month's worth of overhead is a good floor value to be looking at. So ratio of numerator, assets are going to be converted in 12 months, to denominator, liabilities you got to pay in the next 12 months, looking for a ratio of 2.0, or at least 1 month of overhead. And, this is really a key thing right here. Look at that. For my ghetto.
Oh, cool.
Yeah, for my ghetto math is that, look for a balance of 50% cash and current accounts receivable versus other assets. So what oftentimes happens is that we go in to advise a client and they're like, oh yeah, no, my ratio is totally fine. But it's totally fine because this is like 90% of the asset because they've overbought inventory. So they're like, oh, my ratio is fine, but my cash still sucks. It's because even though the asset that they acquired was liquid in the sense that it's going to be converted in the next 12 months, it's not really liquid because I still have to sell it and ship it. Or in the case of a construction company, I still have to bill it, which is going to be based on, predefined contract trigger points that sometimes are outside of my control if I've got weather problems and, I can't get an inspector lined up or whatever. So it's also really, really important that you kind of keep your eye on this 50% ratio. And, the hang up that we often see is that, people aren't really keeping a good track on their inventory. They're letting their inventory balloon or keep out of control. So if it was me, I owned a company, I'd be keeping my eye on this every month and making sure that I'm maintaining this ratio. If I had extra cash, I would distribute it out until I'm down to this ratio. And if I went below it in the next month, I'd let the cash rebuild and then just distribute it out. But the thing you got to keep your eye on is its inventory days. So, there's an accounting equation associated with this that I would politely ask David and Robert to just not speak for a minute, because I'm not going to give the correct one. I'm going to give the for idiots version of this, but anybody can do it. It's real simple. It's COGS divided by days. All right. So that's, so if I'm 3 months in and I've got $1 million in COGS, it's 1 million divided by 90. If I'm 6 months in and I've got 2 million in COGS, it's 2 million divided by 180. Again, this isn't the classic accounting definition of inventory days. I'm not going to give this. This is the ghetto math that you can keep on a running basis, that as long as you're consistent in the measurement approach, it gives you directionally what you need. That's your COGS per day. And then if you take inventory divided by COGS per day, that gives you a days. That's how many days inventory that you got sitting on hand. I get pushback a lot of times around, oh my gosh, I don't know how anybody could have less than 6 months. No, you should be shooting for 30 days, period. Maybe 60 days. And what's funny about that is that when we push clients to say, all right, well, let's take a look at your inventory, it really is a classic Pareto analysis of a lot of our clients are actually really good at buying stuff that sells. And then somebody made some really bad decisions that they're not getting rid of somewhere in the past. So the stuff that sells moves pretty quickly. But unfortunately, they've got a lot of stuff on hand that does not sell. So, your question is, well, how, I need to get honest with myself and move the stuff that doesn't necessarily sell, and then shut the barn door and don't reorder it. Now, a lot of people, one of the balancing acts that you're going to have in this is that, for some people that have bank debt that is associated with inventory, you would, before doing a whole bunch of write downs or anything like that of your inventory or fire sales, you're just going to have to factor in, is this going to have a negative impact on your borrowing base? I looked at the participant list. I didn't see that we had any bankers on, so hopefully they're not going to listen to this afterwards. But my advice on that would be, look, running a calculation in Excel that is the honest calculation, but then not doing anything on your books to adjust for it, but you know what the honest equation is and you're making decisions based on it, at least do that. Like, even if you find that you've got a massive amount of inventory that you need to write off, but you're not going to do it because it's going to screw with your borrowing base, at least you can still manage the business accordingly, knowing that, look, I really only need to be using half that inventory number for the purpose of this equation. So it's okay to go ahead and do your own, kind of ghetto adjustments to this, just to get to the point of where you're really honest with yourself versus, ratio is fine, but why is my cash stuck? Well, the answer is always here, every time. And the same, I didn't use it, Gary, but the same concept applies to AR. It's like, equation's fine, Adam. I don't know what you're talking about. Yeah, but you look at your accounts receivable. 90% of it's greater than 90 days. You're never going to collect from that guy. So that's why I made sure to put in, current accounts receivable. You guys, if 90 days is normal and customary, that's a different story. But to get to a real number that's realistic, use a number that represents really what most people do and factor out the outliers associated with this. So you're at least giving yourself an honest answer. It's not like anybody's giving you an A, B, or C on this. It's meant to help you in terms of how you run the business. So all that said, if you go back to the sale again, you can see the problem is that, look, if the answer is I only need $1 million for working capital to run the business, but my 12-month rolling working capital average is 2 million, there's $1 million that I did not need. You're going to have to freaking explain that to a buyer. And based on my experience, that's not like a slam dunk conversation. That's a negotiation. Okay, well, maybe we believe you, but let's put some money in escrow just to find out. You're far better off just saying, look, let's calculate something, do it, and then, run the business that way moving forward. So that's working capital. On the profitability side, again, this is also an easy one. It's like, people can spend a lot of time worrying about office supplies. Hopefully you don't. People can also get lulled into a false sense of complacency as well, because the numbers are so big. So if I'm making $5 million and I'm like, holy crap, that's so much money, but my gross profit is getting worse, I actually am deteriorating my business value instead of increasing my business value. I'm actually making it go backwards, not forward. So for all of our clients, we start with this second bullet point, which is, while profit margins are industry specific, while bottom lines are industry specific, you kind of got to ask yourself, if I'm a privately held company and I can't even hit 15%, what the hell am I doing? So you really need to start by shooting for this number, is this 15% bottom line. And where we get that from, because somebody's going to say, oh, that's BS, Adam, what you talking about? I mean, if you look at publicly traded companies across all industries, this is the entirety of the publicly traded company universe, they have a bottom line of reportable book income of about 15%. And remember that that's after they record their income tax expense associated with it. So that in and of itself is about a 5% expense. So they just, they have to operate at this level to still be able to pay a dividend yield, which is usually going to be about 2% of whatever the book equity is. So it, that's why, public companies are real tight with what they run from a cost structure standpoint, is because they have to make sure that they're maintaining or increasing shareholder value. Well, in your case, you are the shareholder. So take this seriously. You need to wear different hats. So the first thing is be shooting for a 15% bottom line. If you're not there, start looking at why. Well, the why usually is two areas. It's either people or it's in your cost of goods sold. Um, and, although these ratios are industry specific, you know, good rule of thumb is on, labor. If it's a service company, 150 grand, 200 grand per head is usually about the right number. If you have a product or a cost of goods sold, it's more like $300,000 or $400,000 is a good rule of thumb in terms of the ratio of full-time equivalents to revenue. But what you're really looking for is a ratio. So if my business is, keep this real simple. If I've got $1 million company and I spend 500K on labor, that's a 0.5 or 2 ratio, depending on which way you do the equation. You just want to make sure this isn't ever getting worse, whichever way you do it. Even if your bottom line is improving in absolute terms, there's not really a good reason this number should ever be going backwards. Cost of goods sold, it's the same concept. So what we would challenge our clients to do is to say, look, how can I push this to as high as, somewhere that's pretty close to as high as its theoretical maximum, and then look at what can I improve to make it better. And it's always, kind of down here. I either have an inefficient department or else, too many administrative people, too many salespeople that aren't, really producing. I've got too high of base, manufacturing, the people just aren't getting the widgets through, or I'm pricing stuff bad. So maybe this is really what it takes to produce the product. But at the same time, the price for it is all wrong. I think one of the pricing studies that I did, years back that always still resonates with me was for a medical practice. I was a radiology group that they're like, profit is just going downhill. We don't understand why. Classic doctors love them, but they're not business people. Well, it's because while the volume of their radiology reading had gone up, the nature of the procedures had gotten to lower and lower dollar value. So me reading one thing that I get reimbursed by the insurance company at $10,000 for takes the same amount of time as reading something that I get reimbursed $1,000 for. And I got to pay the people that do that work the same, regardless of whether it's a $10,000 procedure or a $1,000 procedure. Why wouldn't that, if I lose sight of that mix, then I'm going to have a problem here on the labor side. So same thing applies to cost of goods sold. First thing that we always advise people to do is let's rule out the price problem and then start focusing on the efficiency problem. So that's the basics, guys, that we would advise, and we think is applicable to really any client, regardless of industry. If you're not doing anything, at least do that. If you've got, 5 pages worth of KPIs that you're currently looking at, make sure that you at least have those present and accounted for.
Yeah. Let's see here. We've got, all right. Joe has a question. Would revenue per employee be a viable KPI?
Yeah, no, totally. As I said, it's industry. It is industry specific. And then if you take it to a further level, you can break it down into department specific. So for example, in our world, our macro level revenue per employee, we shoot for about $200,000 per head. However, in our bookkeeping group, that's not possible. So what that means is that in my tax department, I need to have a higher revenue per head than in my bookkeeping department, which is going to have a lower revenue per head, so that the two average out to 200 grand per head. And again, the same concept applies in a manufacturing or distributorship environment where you've got a product cost. It's just that instead of 150 to 200, it double it because you've got a cost of goods sold. Those people laugh at me when they're like, it's just not that simple. It's like, look, those are pretty universal constants that we see over and over again within our client base, regardless of industry.
We talked a little bit about this last week, I think, but just understanding profitability across your customers is a really important thing. And it's one of those real basic things that I've seen over and over again, where businesses, especially as they're growing, they just don't understand, or they haven't taken the time more recently to understand where we at on profitability on our big customers. And a case in point, 3 years ago, or not quite 3 years ago, one of my coaching clients, 25% of their revenue at that point, they had concentration risk with this one huge client. The problem is they hadn't done a profitability analysis on each of these big clients, and they were afraid to, and they were just looking at their total margins. Well, their largest client, they were actually losing money on to the tune of $35 per invoice. And so they were terrified to, wake the sleeping giant, if you will. Well, I'm like, well, wait a minute, your numbers, doing more work is going to put you out of business faster. So when they actually had data, they were able to have a sane conversation with the giant, and they found a win-win, but having a preferred provider like this client of mine go out of business was not in the best interest of this big company, publicly traded company. So nonetheless, they brought it up, and that was like a really simple thing that their CFO was able to get into it real quick. If you don't have a CFO, lean on somebody like a Robert Mayetta or a fractional CFO out there, or, to go through those things. And we can help with those kind of things too. Cash flow optimization is something that I think we're really good at. So
yeah, that's right. And I think a lot of what, relevant to, the pandemic is that we've had a lot of clients that have offered discounts, as a way to help out their customers. Well, I mean, at some point you got to look at taking that discount off. And the hard part about that is it's hard to take off discounts. So, just something that's why we felt it was important to just, go back to remembering what the basics are.
Yeah, this is good. Any other questions out there? Joe Lively. That's good. So I'll just tee up a few of these as questions, though, not that necessarily we are going to answer because we're not the HR people, but these are some, I said, hey, Chuck, what are the questions that you're hearing from small and medium-sized business owners right now? Like, what are the most frequent ones? And here are the questions. What's the state of our workforce? Who's engaged and who isn't? Are they mentally ready? It's been a weird year and a half, that's for sure. The second one is what's needed to ensure that we provide a safe work environment for our employees. Third one is, since COVID, what do we need to do to maximize our ability to attract and retain the most productive people? Boy, that everybody's feeling that one. And the fourth one is how do we deal with key employees who are either not vaccinated or not comfortable in returning to the office? These are all questions that we've had internally at BGW as well. And not that we have all the answers on that, but part of it is talking to the workforce, asking them, and then putting together a plan and making sure that they're part of that plan. Anything that you would add to that?
No, I think, welcome to our world. I think the only, it's more like just maybe words of encouragement for everybody out here. That we all, everybody's struggling with the same challenge, which is, geez, I don't want to be an idiot. It's a tight labor market. I don't want to piss off anybody. And at the same time, we got to get back to work. So I think the majority of our clients are either falling into they're falling into 3 buckets, with more and more of them falling into the first 2 buckets, which is, I don't care, everybody's coming back. Bucket number 2 is come back part-time, subject to a schedule, which, a lot of the larger companies have taken that approach, which is, look, everybody needs to be here 2 to 3 days a week, and that's going to start either now or it's going to start after Labor Day. Or bucket number 3, which used to be the biggest bucket, now it's starting to be the smallest bucket, is I don't want to talk about it. So it's just words of encouragement that this feels like one of those Abraham Lincoln moments where you're not going to make everybody happy. So you just got to make the best decision out of a series of bad choices.
Yep. That's good. Well, Adam, you did a great job. I mean, man, every time that I hear you go over this stuff, it's just great because these are the things that are intuitive to you. But having been a business owner myself and run a few, these are the kind of questions that I felt stupid in asking. And I don't think I'm the only one that's felt stupid knowing that, I hear a lot of these same questions from our clients too. So it's cool. I'm glad you're doing that. So if you guys have any other questions in the meantime, feel free. You can always hit me up. We plan on being back here next week, and the theme will be to be determined, but it will have something to do with business tax, business law, or growing your business. So that is probably a certainty. So anyway, we hope you all have a safe and wonderful Independence Day weekend. Get your batteries recharged. Don't start any forest fires with pyrotechnics, and especially as dry as it is out here. So anything else, Adam?
No, that's it, buddy.
All right. You guys have a good one. And anybody that came on here late, we will put it up on the BGW CPA YouTube channel. Thank you, David, for being on here too. We really appreciate you. Y'all have a great day and a great weekend. Bye-bye.
Talk to you later. Bye.